There are a range of different portfolio evaluation measures that can be used that we have discussed in the previous learning objective. So it's important to identify which is the most appropriate under different circumstances. So among the different measures for evaluating a portfolio, which is the most appropriate one? Well, the answer depends on the assumption of your investment, and it depends on the particular investment that you are actually evaluating. So first of all, if we think about the different portfolio evaluation techniques, the way that they differ in each of them have different measures of risk. In all of them, it's a trade-off between expected returns and risk, but risk is measured differently. So if a particular portfolio that an investor is seeking to evaluate comprises the entire investment for any individual, then that means that that asset is not going to be further diversified. Hence, we need to consider the total risk of that asset. Therefore, in that particular case, where there is no further diversification possible, the most appropriate measure of risk is the standard deviation. Hence, Sharpe ratio or M-square measure are going to be the most appropriate tools for portfolio evaluation. In the case where the asset that we are evaluating forms one part of a larger portfolio, that is, we are evaluating an asset that we are going to go and add as a part of a portfolio, then we know that the assets we are evaluating is going to be diversified. So the unsystematic risk is going to be diversified away. It's in that case, we only want to look at the marginal risk that the asset will add to the overall portfolio. Hence, we want to measure risk using beta. So in that case, where the asset is a part of a larger portfolio, we will use one of the evaluation tools that use beta, Jensen alpha or trainer measure. When we are evaluating an active portfolio, we want to trade off the benefit versus the detriments of active management. And the one measure that does is the information ratio. So we use the information ratio to evaluate the performance of an active manager. Or alternatively, if you are an investor who has a utility function whereby factors other than the mean and variance might be relevant in terms of your evaluation of returns, in particular, if you are concerned with the higher moments and skewness, then you might want to use downside measures of risk as supplements. So you might consider the Sortino ratio or the risk-adjusted return on capital. Important to note that though these measures are often used as supplements as opposed to standalone measures of portfolio evaluation. So then when we have looked at different measures of evaluating portfolio performance, it's important to finish by thinking about some of the common portfolio evaluation mistakes. First of all, one common mistake is not to use theory. What people sometimes might do is just simply take a set of data, evaluate it, and assume that means that there is some strategy that's going to continue to work in the future. I can take just a random sample of stocks and find a random sample of stocks that according to all portfolio evaluation measures actually outperform the market. But that doesn't mean that same random sample is going to outperform the market in the future. One way that we can guard against the bias is having investment philosophy that is grounded in theory. So we have the combination of both theory and past performance helping to drive our analysis. Secondly, there is another possibility potentially could be sampling bias. It is that if we are evaluating our portfolio, we should use a relatively long time frame for doing so. If we use a short time frame, what we might find is that there was some specific event that dramatically affected our analysis. Other biases are small sample bias and survivorship bias. What we often find is that we have firms that drop out of our portfolio that might drop out because they become delisted. They might have, for example, gone out of business, or they might be subject to a takeover. In these situations, often we find that there are extreme terminal returns for those particular stocks. So we need to be quite careful about not having a survivorship bias that is not only including those stocks that have survived across the entire sample period. Another potential mistake is failure to control for market performance. What we might find is that if we only look at return on the portfolio, if we don't adjust for risk, then we might just be evaluating a particular portfolio in a period when the whole market is doing well or the whole market is doing bad. In that particular case, just saying that your investment had higher return or lower return doesn't really tell us much. So we need to focus not just on returns, but risk-adjusted return. Last of all, we need to be careful not mistaken correlation or causation. Just because there is some relationship between two variables or two factors doesn't mean that a certain factor has caused higher returns. So overall, it's important to use a range of different tools to evaluate the performance of a portfolio and to fit that up into continuous improvement of your investment philosophy and your investment strategy.